Welcome. I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Greg Carroll, where we're here to provide you insights on the markets, tax planning, and much more. Today is May 14th, and welcome back, Rachel, and aloha. She just got back from a week in Maui, so we're glad to have you back.
You're looking very relaxed.
Thank you.
Even got a little tan.
There you go.
The sun does that.
No kidding.
So over the last week, we have the S&P earnings boom, so that's still coming along. We've had the president visiting. There was the Beijing summit. We've had record highs on the markets. We have the confirmation of the Fed chair. We've had numbers on PPI and CPI. We've had the war in Iran. Looks like that's been a little stable, or there hasn't had much news recently on the headlines because of all this other stuff that's going on, but that's still obviously an issue that's out there. And so kind of still a lot of things going on, and the markets are, it's interesting from last week to this week, kind of looking and reflecting. The Dow Jones is actually down a little bit from last week. However, as of today, and we don't know what's going to happen today yet, but it's looking as of today, the market's going to go up, so it should be pretty much flat from last week to this week. The NASDAQ actually had the biggest move. So the NASDAQ year-to-date is 13.6% as of yesterday, which was May 13th. And so that one had the biggest move. It's up a couple percent from last week. And then the S&P 500 is up from last week. We're at about 8.75. So that has had a little bit of a move up over the last week. And then the Russell 2000, which is the small cap stocks, that's actually down from last week. So it's at about 14.59. But once again, after today, we'll see it looks like it's up a little bit this morning. So we're still in positive territory for kind of the stocks, and it's interesting to see. It looks like some of the tech stocks are still leading the way, which I know Vince has been talking about for some time now. And so looking at some other news, we had the producer price index came in. Last month it was at 0.7, and this month it came in at 1.4. And it's looking at year to date, they're projecting it to be about 6%. So the producer price index measures the change over time in selling prices for domestic products. So that's from the seller's perspective versus the CPI measures the buyer's perspective. And CPI's numbers came in, and those numbers came in at 3.8 as of April of 2026. So we've seen now earlier this year in February was at 2.4. We saw March at 3.3, and so now at 3.8. So obviously we're seeing some changes there.
It's like the highest in over 3 years.
Since May 2023.
Yeah, it's been a little bit of time. Looking at where we're at with kind of the one-year rates, so the CD rates have come up slightly, so we're at about 3.95, and the one-year Treasury is 3.89, up slightly from last week. Mortgage rates have been pretty consistent. We're at about 6.46% for 30-year and 5.8% for 15-year. And so those are just a couple things that are out there. And then looking at kind of the Fed rate change, it doesn't look like there'll be a change at the next meeting, but obviously we'll see what happens. I'm not expecting a change, at least for several months. So there's a lot going on. Like I said, we're still markets are still in positive territory. It looks like they are wrapping up earnings season, so it seems like it's been pretty positive so far.
Yeah, very strong earnings season. It's interesting too when you look at the market. You know, you said the S&P is up 8 and change, Nasdaq's up 13. I think we're setting a lot more 52-week lows than 52-week highs over the last week or so. So I think there's this very narrow leadership, and if those leaders start failing at some point, it could be a little bit of a problem for the market. And along with the CPI numbers being at 3-year highs, the consumer sentiment index is how consumers are actually feeling. They're really starting to feel the pain. The number just came out for May at 48.2, down from 49.8 in April. That's the lowest score since they started keeping these numbers in 1952. Oh. And, most of it's got to do with, high gasoline prices and the tariffs and everything. So especially the lower-end consumer we've talked about a number of times is really starting to feel the pinch. And another statistic here, the consumer sentiment index averaged 56.2% throughout Trump's second term here. He was averaging 93% in his first term. So again, another number that has never been seen before from any sitting president.
It's interesting you mentioned gas. I was kind of curious to know where we're at with gas prices. So I took a peek this morning, and in California, the regular gas is 6.14 is the $6.14. Mid-grade is $6.38 is kind of the pricing right now in California. But I was curious to know what the highest price is going to be, and it looks like in the Bay Area, Menlo Park, it has $7 for regular unleaded gas. I was like, wow, that's outrageous.
Ouch.
That's where Google is.
That's
Right?
unleaded gas. Did you say it was?
Unleaded.
It was regular unleaded.
Regular unleaded.
Yeah, it's like,
You know.
wow. I mean, $6 is still a lot, but
Get that
Costco's even at
Right.
six.
You got to get that.
For
premium.
regular unleaded, and I think it was $6.50. I put in premium unleaded.
Yeah, that's pretty high.
A couple days ago.
I'm sure it's high, premium in Menlo Park when you drive that Aston Martin around. It's
Yeah, those giant SUVs, and
Anyway. No, but I tell you, it feels like who said it's deja vu all over again? Who said that? Was that Yogi?
that was Yogi.
Yeah, it was Yogi Bear. Yogi.
Deja vu all over.
Deja
again.
vu all over again. That's what it feels like, almost every day when you walk in.
Yeah.
It really does. I mean, the market is either.
I'd rather have this deja vu than a couple, 6 weeks ago.
It's crazy. And it's like, okay, you walk in, the market's up huge, or it's down huge, or it just keeps rallying. And you touched on a couple things, and the Iran crisis seems like was front and center for a long time, and all of a sudden earnings season took front and center in the market. You talked about inflation picking up, and it sure is. And now inflation seems to be outpacing wage growth, which is not good from the consumer standpoint.
Right.
Interest rates on average over the past 5 to 7 days have ticked up, and I don't think you're going to get a rate cut anytime soon.
Oh, no.
Not this year.
No.
Yeah, I don't know. It maybe towards the later part, but I don't know.
Not anytime soon.
Excuse me. The market continues to hit new highs, though, and so it's taken all of this bad news and climbing that wall of worry. Over the past 4 to 5 weeks, the market action has been firmly in tech stocks in a very narrow area of technology, semiconductor and chip makers.
Right.
And so the algorithms and the momentum traders have bid these things up to incredible nosebleed levels. And I want to quote what my colleague Greg Carroll said this morning. Things can only go up so far before they tip over.
Oh.
And I kind of like that. Yeah.
Well, yeah, because is up 4% today. That market capitalization is $250 billion created, which is larger than most S&P 500 companies on their own. So in one session, and it's up probably about $1 trillion in market cap over the last 4 or 5 weeks.
Yeah, it's a fantastic company. We're
Yeah.
not saying to buy or sell it, but these chip companies
Right.
have just been on a tear. And of course they're on a tear because that's what's feeding the hyperscale databases.
Yep.
The big question is, when does the money begin to exit some of these companies? And where does it go? Because as we saw earlier this year, what has sold off hard? Well, retail stocks have not done well. A lot of that's because the consumer doesn't seem like they have a whole lot of money with gas prices being at $7.
Even the low end ones like
all retailers have not done well, and it's understandable. You've got the inflation fears, you've got supply chain issues, you've got the consumer being stretched with other types of prices, and then you've got healthcare and you've got software stocks, which have really underperformed the chip makers. So the big question is, when you look out, a year to 18 months from now, will money move into those sectors? Well, oftentimes, monies, when they flow out of very high valuation sectors, they move to lower valuation areas. And that's an area where, it could get some momentum once you start moving out of the big chip names. I don't think it's going to happen anytime soon.
Right.
If you're an investor and our clients and you're holding these big chip stocks, I would not be a seller right now unless you're feeling a little vertigo and you want to take some money off the table.
And it's never
And
a bad idea
never
to
a bad
take
idea.
some
Yeah.
off,
You know,
right?
and-
As it rises, take a little bit more
And
off.
if you
The
take some
concentration,
off, you can
Right.
put some into a 1-year T-bill or a 1-year, what do you say, a CD was
Yes,
yielding about
CD.
4%. So, I mean, you could throw some money in there. Not that I'm a big
Do you know how to
proponent of
do that, Vince? you know what a
no,
CD
I
is?
lean
what
on
I'm hearing.
I lean on Catherine for that. But no, I mean, you could take some money off the table to to put some money there. So
Yeah, I mean, we were talking about Micron and Intel, some of the chip maker stocks earlier today, and the run they've had, and we haven't heard these names and a handful of other names that we haven't heard since the dot-com bubble. Now they're making these amazing runs.
And some of the old tech has done incredibly well, and
Right.
and they're in the chip space. And again, these momentum players are finding, and the algos are finding any chip makers, and they're bidding them up. And what's happening is the shorts that were in there, the short sellers who bet that these stocks are going down, are getting absolutely annihilated. So they have to keep covering higher and higher and higher, and they just keep bidding the prices up.
And again, we are not recommending these stocks.
I'm not recommending. No, I'm just saying.
So I'll be real clear about that.
I have not mentioned any.
I might have mentioned a couple names.
I have not mentioned any.
Just tell you what's happening out in the
Yeah.
marketplace. Just an observation.
Yes.
One of the sectors that you didn't talk about where people's money is going is taxes.
Oh.
And
Oh, yeah.
Oh, well, I asked you about something in Texas
did.
the other day.
yes, you did.
I have
Yes.
to pay $444 extra.
Yeah. But I just wanted to just kind of talk about trends. We are 30 days after, almost 30 days after tax deadline, but we are coming up on the second quarter estimated payments in 4 weeks. So this is a great time to be hitting up your CPA. They're probably back from their vacation to Hawaii or wherever they went. And now can talk to you about your second quarter estimates, which are due in 4 weeks. But some of the trends that we're really seeing is because we do have the additional senior deduction for the next couple of years. People are really looking at what is my income level? Am I going to get that extra $6,000 per spouse if you're over 65? And what should I do with that extra $12,000? Should I do a Roth conversion? I mean, what are some planning things I can do? And we're not saying that's the right thing for everybody.
Correct, because one of the things I also was reading that when you do the Roth conversions, that also changes your income, which
Correct.
you may not qualify the following year. So you have to do some planning to make sure.
You really need to be doing the planning to watch what's going on. But some of the other things I'm really seeing with clients is people are moving out of state. People are selling their homes. There's a lot of tax planning when if you're thinking about doing that. You may not know all of the rules, so you definitely want to to get some guidance on that before you actually put your home on the market to find out what will the capital gains actually look like.
Yeah, it's not that simple anymore.
Yeah, exactly. But it's always a great time of year to do planning. Don't wait until the very end of the year because there are a lot of things we can do this time of year.
So over the last couple of weeks, a few kind of prospective clients that we've met with, just kind of want to share a couple things that have surfaced. One in particular, she is in her mid-60s and wasn't going to retire, but kind of got forced to retire, which is fine. She's in a good place to do that. And when we were talking, she kind of indicated she's more like a moderate kind of risk profile, so moderate growth. She wants some growth and wants to preserve a little bit. Well, when we actually looked at the strategies and everything that's in place, it was more of an aggressive growth strategy tied a lot into the tech stocks. And so she's done very well, but I think really taking a step back and looking at going forward, what's the purpose of the money? What do we need from this money? We need a little bit of income. We need some, maybe some little bit higher quality investments. So not that growth isn't appropriate. It's just, I don't think she realized how much growth she had. And so for her, we're revisiting. So once again, I think looking at how am I invested versus how you think you're invested is really important. And so we're here happy to have those conversations with you. Another prospective client that we're talking with was introduced to us from a client, and she has 5 old 401k plan accounts.
Wow.
She's a high income earner. I mean, really busy with life, but then all of a sudden, the finance stuff just kind of got put aside, and so we're really working with her now to consolidate, organize, and really have meaningful plans going forward, the tax planning and the investment strategy. So once again, it's not uncommon occasionally when you change jobs and you think, okay, I have an old 401k here and there, but also making sure, well, how are they invested and how does it, there you go.
And just touching on what you said, Catherine, it's kind of interesting because a lot of the client portfolios or prospective clients that you see that want to come in as clients, if they own a significant amount of these technology stocks, they probably have huge overweights now in not only the sector, but in the individual names. And we've seen in some of the clients we've talked to where some of their individual names have gotten to 15, 20+% of an overall portfolio.
Yeah.
Now, for some people, they don't care.
Yeah.
But I think for the average investor, I think when you start seeing 20+% of one name represents in your portfolio, that gets a little.
But they're
testy.
feeling very good about
they
it.
feel great about it.
Emotionally,
Yeah.
they're like, I've made a
Right.
lot of money. I'm brilliant because I bought this. But that's again where we got to take the emotion out of it.
Yeah, and I think we talked to them about it, and they've agreed that 20% or even 15% is probably a little too high. So
And so it's just coming up with a plan. And once again, we're not
Yeah.
saying jump in and out of everything, but we really
Right.
work and make sure that we're a little more diversified. And so it's interesting. You said you had dinner with your client and wanting to consolidate and getting ready for retirement, because we've seen that a lot with Rachel and some of her clients. And one of the things that comes into play is, well, now I'm not going to work. Where am I going to get my income from? And where's the best place to take it? And so, once again, that's what we're here for, to help you plan and look at it from a tax perspective, planning perspective, and kind of overall, how should you position your investments to make sure you're getting the income you need. So that covers it. Hopefully we have some more positive news for next week, but I think where we're at year to date, we are still in the green and positive, and we'll see where it takes us for next week.
Keep your arms and hands inside the ride at all
Right.
times.
What about the fear and greed index?
Green is fear and where's the fear? I was just going to say green is good.
Green
Yeah,
is
green
good.
is
Green
good.
is great.
I like green.
Okay, so right now the fear and greed index is at 66. So
66.
which is lower than last week. Last week we were at 70, so I was a little surprised, but that's where we're at right now. Is we're at 66. So
I think some of that inflation factor, and you see it in the news and the gas prices. I mean, over $6 here in California. People are kind of going, this might stick around a while.
And we were just talking before we started that it was extreme fear not too long ago. So that was, as of April 2nd, we were at extreme fear at 13. So had a pretty big change in a
6
short
weeks ago.
period of time.
Crazy.
So just to reiterate to all investors out there, keep your eye on some of the underperforming sectors because money does flow quickly in the market now. Where it used to take a year to 18 months, things move very quickly in 3 to 4 weeks, as we've seen just from the market.
And kind of under the radar theme there as well is with all the build out for these AI companies, infrastructure is a lot of names that people might know of, but they don't really think about investing in. But you got to build the roads, the energy, the pipelines, the concrete, the steel, everything that goes into that. Might be a good area to take a peek at.
All right. With that, thank you for joining us, and we'll see you next week.
Happy investing.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.